Computer audio. Hello, hello. Share screen. Okay, just waiting for a few more. Actually, let's go ahead and start. Hopefully everyone can hear and see okay. I've got my screen sharing going on, so we should be all good here. So we've got one exam out with from a situation with no control by the students. So we'll actually discuss the exam 2 on Tuesday. And so what we'll get into today here is our what's showing up on our agenda, and that's the discussion of Chapter 7, which covers the topic of accounting for liabilities. Get some more light going on in here so I can see a little better. So the PowerPoint is as given here, and we'll just get right into it. So our first learning objective in the class, we talk about notes payable and interest expense. And so what's given here is, this would be if you're following in the book chapter 7, page 248. We discussed notes payable. We started a little discussion about notes payable back in chapter 5 when we were discussing accounts receivable. The very end of the chapter was a small discussion about what would happen if you convert an accounts receivable or accounts receivable to note payable. So we discussed a little bit about the calculation of interest. So notes payable in this instance, this would be you would be dealing with the company who is borrowing money, not the company who's loaning money. So Herrera Supply Company borrowed $90,000 from the bank. A lot of that going on last year. So how would Herrera account for that obligation to pay the bank? They would have received cash in the amount of $90,000, and what would have be given a rise to is a note payable, which anything payable is an obligation to pay someone else, and that is a liability account. So notes payable would be the account which is also increased in this transaction. We do need to take note of the terms of the note, and those are given to us in the problem data. Down the line, we will be asked to calculate interest. And generally these problems too, whether it be in the form of the book or something like on an exam or a quiz, you're going to have a part year of interest to calculate before the end of the year, end of the calendar year. So the note was issued September 1st of year 1. So 1 year term interest and note face value would be all due September 1st, year 2. So as of 12/31, year 1, we'll have to do some accruing of interest expense to be shown on the financial statements of Herrera Supply Company. So the first part would be the recording of the note. So the increase in cash and the increase in accounts payable. So the next problem gives us just that. So December 31st, year 1, we have not paid anything Herrera Supply Company. But as of 12/31, year 1, to get the financial statements up to date, we would have to do some recognizing of interest expense and the related obligation to pay that interest. Instead of just labeling the obligation as something like accounts payable, when you are making an accrued entry like this, the flip side of the entry would be, from interest expense, to recognize that as interest payable. So that way it sticks out a little bit better on an income statement or balance sheet and on the company's, general ledger. So we know where that obligation came from. So calculation of any interest is principal, which in this case was $90,000, times interest rate given to us in the slide before. The terms of the note was 9%, times the time expressed in years. So if it's 4 out of 12 months, as is the case with this problem, then the time fraction is represented in months. We have 4 over 12 months. Excuse me. Which you could also condense down to 1/3 if you so desire. So the accrued interest would be its principal times rate times time. So $90,000 principal times 9% interest rate times 4 months out of 12. So we would have had September 1st through December 1st to accrue. So all of September, all of October, all of November, all of December, which is 4 months. And multiplied out, that figure is $2,700. So that is our entry, is to make sure I don't have anyone else coming in, is to increase interest payable and to also increase interest expense. So there would be an expense recognition of 4 out of 12 months. So for the next financial statement, for the following year, for year 2, we would only have 8 months of interest expense, and that would be the interest which expired, which occurred within year 2, and that is what they will ask us to do in the next slide. So now we get to August 31st, year 2, loan due date. And first thing we need to do is accrue the remainder of the interest expense, or recognize the remaining interest expense. So we need to get our interest payable up to date. So we would recognize the interest in year 2 that happened between January 1st and August 31st. We would record that in a similar entry as we did the slide before, just a different figure. So our interest expense for January 1st through August 31st, 8 months of interest. Begin the same principal, same interest rate, and then the time factor would be 8 months out of 12. So instead of a full year's interest, we get for year 2, $5,400 interest. The interest payable comes out the same. It's the income statements which are affected, as the interest expense would be deducted. The $2,700 of interest expense for, it was $2,700 for year 1, would have been taken as a deduction in determining year 1's net income. The $5,400 interest expense from year 2 would be recognized on year 2's financial statements. Altogether comes out to 1 year's interest, or $8,100. That should be the balance of the interest payable account after this entry has been recorded in the books. So second expense, you could combine the second and third transactions, which are on the top of 49, into one entry. that can be done. But the book split the two out, and perfectly fine. So we're going to pay interest first and then pay principal second. So the interest, which is paid on August 31st, year two, they do mention it's an asset use transaction. So we are decreasing cash and not affecting any other assets. What we're doing is decreasing an asset and decreasing a liability account, and the liability account being interest payable. So we would have a statement of cash flows event, and that's $8,100 outflow of operating activities for the interest expense. It is a little bit curious that the borrowing of the note itself is a financing activity, but the payment of interest is an operating activity. But that is the categorization. That is correct. So then our next transaction would be to repay the principal. So that would be just writing a check for $90,000 in settlement in full of the note payable obligation. So that would decrease cash and decrease notes payable by $90,000. And it would be a cash outflow for financing activities of $90,000. There we go. Got someone else. Okay. So sales tax liabilities, just a very, very small bit in this chapter. And I mean, small, like barely half a page. So how sales tax liabilities are going to affect financial statements. Sales tax would be what's called a current liability. And that was mentioned at the top of 248, that the beginning of this chapter, we talk about current liabilities. The second part, we talk about long-term. The measuring stick for current versus long-term is 1 year. So any obligation due within 1 year is what's called current. Anything beyond that is long-term. And they are represented separately in the balance sheet. We just label those liabilities as being current or long-term. And that will be used, the categorization is important when it comes to chapter 9, which is our next chapter we cover, when we talk about financial statement analysis, because there is one very commonly used ratio, a liquidity ratio, which is called the current ratio. Okay, so sales tax, retail companies, you have to collect sales tax from your customers and remit that sales tax to generally your state's Department of Revenue. Some states, state of Illinois, offers the retailer a discount for timely filing of the tax return, the sales tax return, and payment. And tell you, Illinois, if you're a monthly filer, your return is due 20 days into the next month. So like a March sales tax return would be due April 20th. And you have until then to pay as well. Illinois' cash discount for timely filing and payments, 1.75% of the tax collected. So it's an incentive to file and pay the tax on time, because you don't have to remit all of what you've collected in terms of sales tax. So most states do require companies to collect and remit sales tax at regular intervals. Depends on the state. Different states have different schedules as to how often the retailers have to file the sales tax return and pay the sales tax itself. There are a handful of states which do not have sales tax. And I do know that one of them is Alaska, surprisingly. Actually, we have 5 states That's Alaska, Delaware, Montana, New Hampshire, Oregon. Don't have sales taxes. So not many, most states, 45 out of 50 do require the collection and remittance of sales taxes. Sales tax, it is a liability to the retailer until it's paid to the state. So what you would receive from your customer, part of that would be, some would be revenue, some would be sales tax. So say I went into Kroger and I bought, we've got like 9% sales tax here in Peoria, so it multiplies out pretty good. If I bought $100 of general merchandise at Kroger, not food, because there is a lower tax on food. But if I bought $100 of merchandise, paid 9% sales tax as the customer, I would be paying Kroger $109. Their revenue portion is only the $100. The $9 is an obligation for Kroger to pay the state of Illinois sales tax collected. And that's what we have going on here. We had a company which apparently has a 6% sales tax, received $2,120 in cash from a customer for the sale of $2,000 worth of goods. So our revenue account is what we received for the sale of goods. That, however, does not balance with how much cash we received from the customer. So we sold $2,000 worth of goods, we received $2,120. So we have to account for that $120 somewhere. And what that is a current liability. It is an obligation for the company to pay. This would be also Herrera Supply Company. Say they're established in Wisconsin, maybe. So they have an obligation to pay the state of Wisconsin $120 in sales tax. So that is the account increased would be sales tax payable for $120. And that makes our transaction balance. So there is no, sales tax expense to the company, because actually the company is just acting as an agent between the customer and the state. They're receiving the sales tax and sending that sales tax right over to the state. And they did give us the little blurb here that HSC sold merchandise to a customer for $2,000, cash plus sales tax. And we have a 6% sales tax rate. So when the sales tax is paid, and this is assuming there's no cash discount, the transaction is merely just a reduction of asset, reduction of cash, reduction of liability in terms of sales tax payable. So it's not an expense transaction. We're acting as a third-party agent between the customer and the state. So contingent liabilities, middle to end of page 250 in the book. And there's also a chart on the top of 251. Contingent liabilities have not happened, but there is a potential likelihood of those obligations occurring. So whether or not we record in the books, it depends. And it depends on what? The criteria here, which are presented, same criteria, which are about 2/3 of the way down the page on page 250. It all depends on the likelihood. And most often, contingent liability, you're talking things like, warranty obligations, or even the potential of a lawsuit settlement. But if the likelihood of the company having an obligation due to some sort of event that we don't know yet because that event has not happened. Say we have a lawsuit which is we haven't gone to court yet for that lawsuit. So the company might have, and maybe we're talking Herrera Supply Company again. I'll say they got sued by a customer for some defective goods. We don't know yet. We don't know what the outcome is going to be because we haven't gone to court. So it depends upon the likelihood of that future event. And so if there is a likelihood that's probable, we go to our attorney and the attorney says, yeah, you're likely going to have to pay, between, $10,000 and $15,000 to the customer. So if the likelihood is probable and could be reasonably estimated, then we do actually recognize a liability in the financial statements and disclose it in the notes as well. You forgot that part, but you do disclose. If you have reasonably, you go to your attorney and they say, well, we might be able to fight this. So are you going to be out money? I really don't know. That's the case. We don't have a reasonable estimation available to us. But yeah, likely we're going to have to pay something. We don't know what. In that case, we don't recognize any liability, but we do, disclose the facts and circumstances about the lawsuit with, leaving parties' names out of it, of course. Just get very general on the events and disclose it in the notes to the financial statements so that any party who's using those financial statements can make an informed decision about whether they're going to grant credit to the company or approve a loan, whatever the case might be. Maybe a potential investor wanting to invest in the company. Same circumstance, excuse me. So if we have the same circumstances with HSC, go to the attorney said there's no way that customer is going to see any money. This is a frivolous lawsuit. We're going to win. Then we don't only have to not only record, no liability, we also don't have to disclose anything in the footnotes. So that's a contingent liability. And there is a chart, and this is the kind of the decision tree that's up on the top of 251 that and it gives you the course of action determined by how likely an outcome is that the company will have to spend money and the ability to reasonably estimate that liability. So probable and reasonably estimated, yes, recognize the liability. Probable but not reasonably estimated, just disclosing the footnotes, but no recognition of liability. Remote likelihood, do nothing. Okay, so warranty obligations, this would be one of those contingent liabilities. So warranty, what you're having with a warranty is a guarantee to your product. We'll sell you this piece of equipment, and if something goes wrong with it within the first, 1,000 hours of use of the, maybe it's like a tractor. And if you use this tractor for 1,000 hours and something goes wrong, the seller of the tractor will fix anything that goes wrong with it. And usually that's backed by the manufacturer of the tractor. So you have a warranty period, for vehicles, it's based on miles or years. General warranty is a 3-year, 36,000 mile. If I have a problem with my car by 36,000 miles or 3 years, whichever comes first, I'll say my transmission goes out at 24,000. I get the car to the dealership. that transmission will be fixed at no cost to me. The expenditure, the cost would be at the expense of, General Motors, would be the one who would be out so much money. So we do a little example of a warranty here, pages 252, 251 to 252. So the first event on the bottom of 251 is selling merchandise to the customer at a cost of $4,000. Or going back in the material a couple of chapters. This would have been chapter 3, I believe, that would have had the discussion about accounting for sales transactions. So sale of merchandise, we record that as two separate transactions, one to record the sales proceeds. And as what we learned before, if there's any sales tax collected, that would be accounted for in event 1A as well. Apparently, we don't have any sales tax on this transaction. Would have been a nice place to bring it in, though. So we sold merchandise for $7,000 to our customer. That merchandise cost the company $4,000. So event 1A is the sale of the merchandise. So increase to cash, $7,000, increase to sales revenue account, also $7,000. Event 1B is the recording of our cost of goods sold. So we decrease inventory and increase cost of goods sold by $4,000. So in terms of statement of cash flows, the only event we have which has any bearing on the statement of cash flows is that event 1A where we received cash. Okay. So event 2, we're going to have some warranty expense. And this could be done through an approach similar to what we saw with accounts receivable and estimating, the allowance for doubtful accounts. This is an approach similar to the percentage of sales method. So you can base your warranty expense on, as a dollar or percentage amount of your sales. You could also base that on, the actual equipment sold. These are all just estimates. So estimates get refined over time. So we have a warranty obligation, and the book does mention the exact amount of future warranty claims is unknown. We do have to come up with some sort of an obligation. So this is the assumption. Could be, again, the estimation method which is used. We would make some disclosure of that in the financial statement in the footnotes. Generally, there'd be a section in the footnotes about liabilities and specifically warranties payable. And the footnotes would disclose how did that $100 get calculated. So our estimation is that we think the obligation under warranty expense will be $100. Whether or not it's true depends on future events, again, that we don't know, but we have a reasonable estimation. So the warranty itself states that we guarantee our merchandise will be free from defects for a year following the date of sale. So we have a 1-year warranty. Anything that goes wrong with the equipment within 1 year, it'll be taken care of at the manufacturer's expense. So we actually had a warranty claim in event 3. So customer returned defective merchandise. HSC worked on the merchandise, had to pay for some parts, and so this would be for the payment of the parts. So we would have spent cash of $40,000, and we would have a warranties payable. That account we actually decrease whenever we have a warranty claim, our payable is decreased by the amount of that claim. So we would have expended $40 of our estimated $100 of warranty payable in the form of this customer, his claim. So what they show now is, financial statement, our presentation of warranties. They are a liability. And in this financial statement for year 2, the events we've had going up to this point, we had the issuance of, for year 2, for year 1, we had the issuance of note payable, but that note payable got paid in year 2. So that's why the note payable isn't showing up in liabilities. The balance was 0 at the end of the year. There should have been some interest expense in the year 2 income statement, but apparently ignored that. So warranties payable, it would be a liability, and it would be a current liability specifically. Okay, so we get into, we switch gears from current liabilities into what's called long-term liabilities now. Long-term, again, that measuring stick 1 year. Anything due at a date beyond 1 year from the financial statement date would be deemed long-term and labeled as such in the balance sheet. And current liabilities, those are due within 1 year or the company's operating cycle, whichever's longer. 99.9% of the time, it's 1 year. So interest rates, again, generally have interest rates on long-term debt, and principal repayment can either be one lump sum or in installments. Anyone who's had a car payment or a mortgage payment, you're paying a mixture of principal and interest on a regular basis. You're not paying, I don't take out a mortgage for 30 years and pay all of the interest and all of the principal 30 years from now. It happens monthly. And those payments are both a mix of reduction of liability and interest expense. So installment notes is what we're talking about here, and this is page 254. You generally utilize what's called amortization schedule in order to get the breakdown between principal and interest. There is one presented in the book, and it'll be in a couple of slides. And that is Exhibit 7.3 on page 254. So how installment notes affect financial statements. When you have, our first event is going to be the borrowing of $100,000. And at 9% interest, due within 5 years. Well, we're going to pay that installment note on a regular basis. In this case, it looks like it's going to be annual payments of both principal and interest, but the payment amount will be fixed. So what we have to do is a loan amortization. So our Blair company, again, they borrowed $100,000 cash from the bank. So our cash increases, our note payable increases. And as this note payable is due at a date beyond 1 year from the financial statements, we have a long-term liability. So it would be labeled as such in the balance sheets. And cash flows, this would be a financing activities event. So amortization of principal and interest, the factors we need are the amount of the loan, the interest rate, either the number of payments or the actual payment amount. It is actually based on the formula for present value of an annuity. So interest expense will be part of the loan payments, so will reduction of principal. So the way the loan amortization table looks, and I won't ask you to actually prepare one of these because it is a bit of an odyssey to get to a loan amortization. And there are so many available tools, especially Microsoft Excel has a built-in loan amortization template, which is about as good or maybe even better than something you can buy. Proprietary software, which I do have one, but it's very old. This was before Excel started providing amortization templates. So an installment loan payable amortization schedule will look like this. The way the interest expense is calculated, it's going to be the principal balance times the interest rate. The $25,709 was achieved through a formula, be the present value formula for an annuity. Based on $100,000, 9% interest in 5 years and annual payments. So if you took a total of the total cash payments, those are going to exceed $100,000. And the reason for that is interest. So you may have your last payment may vary from the rest by like $1 or $2. That's due to rounding. In this case, the book rounded the payments to the nearest dollar. If they would have gone to the nearest cent, it would have come out to probably about the same payment, maybe a penny off on the last one. But that final amount is due to rounding. So the payment of that first year's loan, December 31st, we would spend $25,709. We follow the year one row across. $9,000 of that payment would be interest. The remainder, or $16,709, is reduction of the principal balance. So our principal balance at December 31st of year one, we started out at $100,000. Payment one reduced our principal by $16,709. So subtraction of the two figures gives us $83,291. That will be the principal balance January 1st of year two, and the basis of the interest calculation for year two's payment. So how we would recognize the payment of payment one in our financial statements model will be, the cash payment will always be $25,709, $710 on the last year. The breakdown between note payable, reduction, and interest expense, it's going to be different every time. It'll be the numbers that come directly off of that amortization schedule. So there'll be 5 entries to record the notes payable at December 31st, years 1, 2, 3, or 2, 3, 4, 5, 6. And at the end of year 6, note payable balance will be 0. And you'll pay more than 9% total interest. So the total interest paid for the loan is much more than $9,000. And that's because the term is being stretched out over 5 years. It's 9% per year. And so it doesn't come out to exactly, 9 times 5 either. So, and that has to do with the fact that some of those payments, portion of those payments are reducing principal. So you'd be paying interest on less principal. So when you have something like a 5-year loan with, annual payments, a loan amortization is pretty easy. You get something like a vehicle loan where you're stretching out 6, 7 years, monthly payments. That's a lot of entries to log. You're talking 84 payments possibly. So the financial statement presentation of our note payable. Apparently this company did not, they haven't discussed classified balance sheets yet, which is why the book is not presenting the liabilities in terms of current versus long term. They don't do that until about the end of the chapter, page 267, 268 specifically. So technically, our note payable would be long-term in nature. Okay, so line of credit, how that is presented as a financial statement item. This is bottom of 256, top of 257. Line of credit is just an open note that you can draw off of whenever you need cash. Basically like taking a cash advance on a credit card, so to speak, but much more favorable interest rates. So you might have a line of credit which is secured by an asset. They generally are, and that helps the interest rate be reduced a little bit. So line of credit, you can borrow and repay funds as you need. Yeah, if you've borrowed $10,000 and you only need it for like 6 months, you pay interest and then you pay the principal as you can. And if you don't have the cash, you just pay the interest. If you have the cash to repay the principal, then you repay that as you can, and that will replenish your line of credit. Say if you started with like the book says, we had a $50,000 line of credit here. No, $100,000. $100,000 line of credit. And we need just $10,000 to make the bills for this month. Then we borrow $10,000. We would pay interest on $10,000. And we would repay that $10,000 when we could. And as soon as we repay the 10, then our available line of credit goes back up to 100,000. So what's specified, the amount that can be borrowed is going to be the underlying loan agreement. That'll also specify the payment terms, the interest rate, how often interest is paid. We've had a line of credit at our business before, don't have one now. Don't really need one currently, so that's good. But generally you repaid interest every month. And if a line of credit drags out long enough, your bank may request that be converted to an installment loan. It does tend to happen. Interest rates, they do fluctuate. It's generally, dependent upon the federal rate. Plus, if you have any assets securing the loan. And line of credit, typically you do have a 1-year term. At the end of that year, you and your bank renew the loan. And at that point, you make any adjustments to the principal. Do you need more funds? Do you want to cut it back? All up to the negotiations between you and your loan officer. So an example, we're doing a different company right now. We have a company that is called Lagoon Company. We don't want a mortgage yet. Well, actually, sorry, they're building up inventory, not a building. So getting started, you have to usually go into debt to some extent. And a line of credit if you don't have any assets to secure your loan, can be a good way to do that. If you know that you're going to need to borrow money just for a short period of time. So this company is just getting off the ground, building up its inventory. So there's not sales revenue coming through the door right now. We need to build up the inventory to get us those sales revenue. So once we get the inventory built up, Lagoon is going to be able to pay this loan off, or at least pay, they'll pay the balance down as they can, and eventually they pay it off. So every month there was maybe some, March 1st, funds were borrowed from the line of credit. And we had, looks like probably $100,000 line of credit, possibly even more. But that's the highest the loan balance got, was 100,000. So March, there was borrowing of $20,000. So the recognition of the interest would be, 9%, which was the loan terms. And generally that's set for 1 year. When you renegotiate the note, you're going to have a different interest rate typically. And in this example, though, they have an interest rate which is fluctuating. So that's another option. So we have a 9% interest for March and April's draws. And so for March and April and May, Lagoon Company would only be paying the interest expense on the loan. They're not paying any of the principal yet. So between March, April, and May, companies drawing $100,000. June, sales start to happen. So as the sales revenue starts to come in, Lagoon can start to repay that obligation to the bank. So June, they make a $10,000 principal payment in addition to the interest. July, even more sales revenue came in, so they were able to have enough cash to pay $40,000 of the principal. And August 1st, they were able to pay the thing off. So it's never a bad idea to actually have, a line of credit, just in the event that you need one. Things happen like coronavirus, where, unforeseen circumstances come up. You have a big bill which is due that you didn't see and weren't expecting. Oh, maybe your furnace goes out. You don't have time to go to the bank and, take out a mortgage. You need to get this furnace replaced now. So lines of credit are good for emergency use and for, financing operations as well. So bonds, there's a pretty good size portion of the chapter here on bonds, about 2-3 pages. Actually, it's a little more than that. They get into bond issuance and bond principal and bond discount. And then actually, that goes on for several pages. And bonds are a bit of a meaty topic. So that is why there's so much material spent on the topic, because there's a lot to it. So bonds, what those are, they're bond certificates that are offered to the public. It's a way for a company to raise money without having to issue stock and without having to borrow from the bank. It's a company's obligation, to pay the interest and to repay the principal. Bonds usually pay interest at specific dates and then the principal at a future date. And a lot of municipalities do bond issuances. Like state of Illinois will offer, bonds to finance certain projects. Like housing authority issues bonds to, finance some of their projects. And the interest rate usually is dependent upon the, financial stability of the company who's issuing the bonds. So as you can guess, Illinois' bonds have a little bit of a higher interest rate because the state's not so stable financially. And that is one issuance, that is one example where a company's financial statements would be scrutinized by, you know, like a bond rating company, and that would determine their interest rate as to, because it's generally dependent upon the financial, like I said, the financial stability of the company who's issuing bonds. So from the issuer's point of view, what the bond represents, you get money now from bondholders, and you have an obligation to pay that principal at a future date and interest at regular intervals between the issue date and the maturity date. So what bond has over banks and what bond has over stock is that as opposed to a bank bond issuance of bonds, you can generally go out longer. Instead of having a line of credit that's 1 year, maybe you have a 10-year bond issue. 10 years is not uncommon. Bond interest rates might be lower than banks, or they might not. Sometimes you take out a bond issue because you're extended at the bank. You're overextended. They won't loan you any more money. You've got no choice. So longer terms, you've got time. You've got time to build up the cash reserves to get the bond principal repaid. Interest rates, if you do have interest rates which are lower, that of course benefits the company just by not having to pay as much cash out in the form of interest. And you don't have to deal with an intermediary. If you have a company that can issue bonds directly to the public. If you offer bonds through like a brokerage house, yeah, there's going to be a fee to pay, but it might be less than what the bank asks. So bonds can be issued at what's called face value, for a premium, or for a discount. And we'll get into each of those topics separately and why a bond would be issued either at face value, at a premium, or at a discount. So we've got an investor, we've got Marcia Mason. She's an entrepreneur. She needs to seize a business opportunity. The bank's laughing at her, basically. You don't have any assets. You don't have anything. You know, we're just gambling right now, and we don't want to gamble. So she offers this opportunity to her friends. You know, hey, invest. I'm offering a bond issue. 5 years out, I'll repay you, and I'll pay you interest payments every year if you'll let me borrow money from you. So maybe you couldn't borrow $50,000, but you could borrow $10,000 from 5 people. That's basically a bond. So as collateral, she has a piece of land. It's like, okay, if I don't make good on these bonds in 5 years, I'm offering this land. So she's serious. That shows her intention. That shows that she's serious about paying the bonds back. Because if she doesn't, the holders of those bonds get a piece of that land. So she got some takers, issued the bonds, received cash January 1st, year 1. She needed to raise $100,000. So she got $100,000. Doesn't have to be equal. One of her friends could have loaned her $10,000. One of her friends could have loaned her $50,000. Someone might have loaned her $1,000. So what you invest in those bonds is up to you as the investor. But altogether, the bond principal that's being sought was $100,000. Once she hit that, she stopped. So she issued the bonds, took the bond payment, and bought land. So this could have been, possibly maybe this was farm ground or something. gonna invest, it looks like we're gonna invest the land, get a little revenue off of it, and then flip it. So probably some farm ground would be my guess. So issued bonds for cash, bought the land for $100,000, earned some probably rent income off of the farm ground, paid interest on our bonds in event 4, and then we turned around and sold the land. So that's the way this event happened. So apparently she bought the land, got rental income off of it for 5 years, then turned around and sold the land for exactly what she paid for it, and paid the bonds off with the proceeds from the sale. So this is bonds at face value, because $100,000 worth of bond issue, cash received was $100,000. We'll see events that are less than that. That'll be starting. Actually, we'll see first event having to pay more for your bonds than what you received. Okay. So bonds at face value, there's no premium, no discount that we have to worry about, which is nice. The bonds payable would be a liability, specifically a long-term liability. And this shows the events, the financial statement effects of the bonds in each of the 5 years. So unlike an installment loan, the interest expense for bonds will be the same every year. So we'll have interest expense of $100,000 times 9%. And bond interest paid is always the face value of the bonds times interest rate. That's not always equal to interest expense, and we'll see that when we have a bond discount and a bond premium. So we earned interest or rent revenue of $12,000 every year, paid out interest of $9,000 every year. So over 5 years, our entrepreneur here, she earned $12,000 in interest or revenue, paid $9,000 in interest, netted $3,000 every year. So over a 5-year project, she walked away with $15,000 and sold the land. So not too bad of an investment. And that's even after paying the interest expense. So the cash flow, the operating activities, there'd be transactions every year in the form of inflow of rent from customers, an outflow of interest to the bondholders. And our investing activities would have had events twice, and that was in year 1 to purchase the land and in year 5 to sell the land. And same with the financing activities. We would have cash inflow in year 1 when the notes were issued, and cash outflow in year 5 where the bonds were paid. Okay. So bonds issued at a discount. Well, Mason's friends said, well, we can invest our money elsewhere, and we can get more interest. The interest you're offering is not enough. For your $100,000 of bonds, we'll pay $95,000. So that actually gives those bondholders would be an additional $5,000 of interest income over the life of them. So Mason, desperate, says, okay. So this is a bond issued at a discount. And specifically, those bonds would be issued at, those would be bonds issued at what they call 95% of face value. So bond discount, it increases the interest that Mason ends up paying to the bond holders because the interest is based off of the interest rate times the actual face value of the bonds, which is $100,000. So the bondholders will get the same interest that they would if they bought the bonds at full face value, but they get an additional amount at the end of the term of the bonds, because instead of receiving $95,000 to settle the bonds, they receive $100,000. So instead of $45,000 of interest over the life of those bonds, it's $50,000. So she receives $95,000 in cash. And now our bond liability comes into carrying value of bond liability, because we're going to have a discrepancy between interest paid and interest expense. And what we'll do is we'll actually end up increasing the carrying value of the bond liability as we make interest payments. So there is an account, it's a contra liability account. So under the umbrella of carrying value of bond liability, there would be two separate accounts, and that would be the bond liability itself, the bonds payable, plus there would be an account called discount on notes, discount on bonds payable. So this approach is just showing the net result. So, but in reality, there are two accounts involved. And that bond liability would always be $100,000. And the discount on bonds payable account would start off with $5,000 balance. And it'd be a direct reduction, an indirect reduction to the bond liability account. Excuse me. So this would be our initial transaction, would be cash of $95,000. Technically, you would have an increase to bonds payable. You would have a negative balance in an account called discount on bonds payable, which would be $5,000. And that account would be adjusted as the interest payments are made. And then statement of cash flows, you'd have a $95,000 inflow from financing activities. So she pays $95,000 to purchase the land because that's all the money she has. And in this example, they also monkey with the cash revenue. Don't know why they kept the numbers different, but I don't know. There was some method to the madness. So our event 2, we purchase land. Our event 3, we rent the land for a little bit less than what was the case before. Event 4, we're going to recognize our interest expense. We paid our interest payment to our bondholders, which is going to be $9,000. So it's going to be the face value of the bonds times the stated interest rate. That will be the cash payment all five years. What we're going to have happen, there's going to be two elements to it: the cash payment and a reduction of the discount. So we employ different methods, just like with depreciation, just like with recognizing bad debts expense. There are different methods that are used to amortize a bond discount. Most commonly, we see the straight line method, and that's what we're going to look at. There is a method called effective interest rate, which is in the appendix. We are not going to discuss that because that gets a little involved, and that actually has an amortization schedule, which is kind of similar to amortizing a note payable, and we're not going to worry about that. we'll just look at straight line method. It is the easiest to calculate. So if you have bond discount or bond premium amortized using straight line method, you've got the same interest entry every single interest payment. So it makes life a little bit easier. So we're going to also recognize as interest expense with each interest payment a portion of the bond discount. So effectively that will increase interest, not only to the bond issuer, but to the bond recipient. The timing will be a little bit different for the two of them. For the bond recipients, the interest event won't happen until year 5. So for all 5 years of bond payments, our bond issuer will expend cash of $9,000 and increase the carrying value of the bond liability by $1,000. $5,000 discount divided by 5 years of bond maturity. And then effectively the interest expense becomes $10,000. And we'll have that same entry. So $9,000 decrease to cash. This would actually be $1,000 positive adjustment to the discount on bonds payable account. So it'd be the contra liability account. And then also we have an increase to interest expense of $10,000. So all 5 years, we will have that same transaction event 4. We'll show that we'll have that entry December of year 2, 3, 4, 5. And then year 5, the land gets sold equal to its book value, and we pay our bond liability off. So remember, we only received $95,000 for our bonds, but we have to pay $100,000 to our bond holders because those bonds were issued at a discount. So to the bond holders, that's when they receive an additional $5,000 of interest income at maturity. The bond issuer has been amortizing that additional amount all along with the payment of interest. So by year 5, our discount on bonds payable will be 0. And our liability for bonds payable would be $100,000. So we would expend $100,000 cash for $100,000 of bonds liability. And it is a split in terms of the statement of cash flows. We have a financing activity of the original amount of the bond issue of $95,000, and we have effectively paid interest of $5,000. That part was not recognized on the statement of cash flows yet, though. That's why that happens at bond maturity, even though we were accruing or amortizing the discount that had no effect on the statement of cash flows, not until the cash was paid out. So $95,000 was to settle the bonds. $5,000 was interest. So that's why the split between financing and operating activities. So the way this bond issuance would look like for all 5 years of its life is the same as what we see on page 265. The statement of cash flows is on the next slide. So basically, our income statement is going to be the same every year. Our balance sheets will look a little bit different, and you can see, pay special attention here to the liability section. At the end of year 1, our bonds payable is always going to show $100,000. The discount will be reflected in the discount on bonds payable, which is presented alongside that bonds payable account. And as time goes by and the interest payments are made and the discount is reduced, our discount account, it shrinks. So by the end of year 5, we have a zero balance. And we're just paying the principal off. So then our statement of cash flows, again, cash flow activity doesn't happen until year 5 and year 1. So we'll have the inflows for a cut from rent, the outflow for interest every single year, the outflow to purchase the land and the inflow from the sale of land will happen in years 1 and 5 respectively. The financing activities, the inflow from the bond issue happens year 1. The payment for the bond issue happens in year 5. However, we didn't just pay $95,000 to settle the bonds, we paid $100,000. So the $95,000 is financing activities. There's an extra $5,000 included in the outflow for interest. That's where that differs. So this is a good place to stop because we're actually switching to bond premium at this point. And I say that's a very good place to put a bookmark on where we are. So that would be the top of 266. That's where we'll pick up for next time. And we don't have a whole lot more material to cover in the chapter. It's really just bond premium discussion and talking about current versus long-term. And that's really the extent of the material that we have for chapter 9. So what we'll look at is some problems. And specifically, our problems for next time that we'll look at will be exercises. And those will be 7.1, 7.1a, 7.4a, 7.7a, and 7.10a. What each of those discuss, specifically here, exercise 1a is recording accrued interest expense. There's a bond, or a note issued October 1st of year 1. What will the interest be? How much will be paid in year 1? There won't be any interest paid in year 1. Interest and payable are going to be paid at maturity date. And then they'll ask how much interest will be recognized on the income statement in year 1, in year 2, how much cash paid out will be in year 2, etc. So that's 7.1a, has to do with accrued interest expense. 7.4a is has to do with sales tax payable and how each of the transactions are recorded in the financial statements model that is presented within the problems data. 7.7a is deals with warranty obligations. We'll have an estimate of warranty obligations and an actual expenditure to repair some equipment that was returned to the seller for repair. And then exercise 7.10a, we have an amortization schedule. What will be asked is part A, what rate of interest is being paid. Kind of easy to see from year 1. One hint is you take the interest, the amount applied to interest, divide it by the principal. That is your interest rate. And then they ask you to do, in part B, recording of the issuance of the note payable, record the first payment of the note payable, and then in part C, they have us record, they ask us for give us a couple more pieces of information like cash revenue and expenses, and ask us what is the net income from year one, what would cash flow be from operating and financing activities, and what would be the interest expense on the loan for year 4. So we'll need a line that we don't have is what's being asked for, is basically produce accounting period year 4. So that's where we're going for next week. We'll finish the material. We'll actually go over the, we'll have all the exams in by that day and we'll go over those. So far, what I've received scores are good. So looks like everyone did really well. And then I'll have any adjustments that need to be made to the grade, and I'll have the grades posted as soon as I get the last exam in. So that's where we're heading for next week. We'll go over the exercise, go over the exam first, exercise the second, finish our material, and then we'll have some more problems to be assigned. So that's all we have for this week. If there's any questions, please feel free to shoot me an email. I'll definitely get back to you. Might be in a day or two because I'm working a lot these days. So, but I will get back to you. So there's no questions. Then we will see you next Tuesday, and hope everyone has a good weekend, and hope you get a chance to enjoy the weather, even if it's a little chilly outside. So we will see you next Tuesday. And I will post a recording of this onto Sakai as well. So that'll probably be later today. All right, we'll see you Tuesday. Bye-bye.